We had a fairly strong day yesterday in the markets. We noticed green pretty much right across the board, although for the large part the Mag 7 was down slightly, so there should be no surprises that whilst investor sentiment is still fairly bullish, we are sitting at extreme fear in 20. It is getting a lot better from just last week where we were in the low single digits, and that's pretty obvious to comprehend when we look at just the last 5 days in the market. We have seen quite a strong reversal, quite a large bounce from the tariff tensions, although whether or not this is sustainable is something to consider. And we're now kicking off earnings season with, in fact, LVMH. They reported their earnings for Q1 2025 just yesterday, but we also have some other interesting companies that are reporting this week. We have ASML before the market open tomorrow, Taiwan Semiconductors on Thursday, American Express, as well as many others, so make sure you are subscribed. We are going to go through quite a lot of these as they do come along, and it's not just earnings week. In fact, it is truly earnings season. Just over the next 4 weeks, we are going to see a lot of companies that are reporting their earnings, which will give us a better indication of how this tariff situation will unfold, what the expectations are, whether we will see any revisions to their guidance, and in terms of their latest figures. Now, we are covering LVMH today. For those that don't know, they're effectively a French luxury goods conglomerate owning more than 75 prestigious brands across fashion, jewelry, cosmetic, wine and spirits, and they used to be, before the earnings today, the world's largest luxury company. They have now in fact been dethroned by Hermes, and as we can see, it is due to a sales miss. Unfortunately, this wasn't to be expected, but they did have a drop in their Q1 sales, something that we will take a look at in a bit of detail, and we can see from analysts it was for the large part below the most conservative buy-side expectations. And just to highlight the drop we have seen from the company, just last year LVMH was, as we said, the world's largest luxury company. It has now been dethroned by Hermes, which, as we can see, just last year had a market cap around half the size of the company. So very interesting to see the downfall this company has had, although you could argue, given what is going on in the global economy, maybe it isn't much of a surprise. And we're now unsurprisingly getting a lot of cuts to their price targets. Goldman Sachs, in fact, are dropping their price to €610, and this is after the earnings that we have just seen. They weren't impressed, they did want to see growth, but unfortunately the bottom line just wasn't what they wanted to see. And they're not the only ones. We also get a price cut from Morgan Stanley, but we just want to highlight they are in fact down around 8% just on this earnings drop. But that isn't the only fascinating thing. If we were to look at this company over the last 5 years, the performance where it's been right now at the $488 mark, you would pretty much have made no gain if you bought this company around 5 years ago. That is definitely a fact that long-term shareholders do not want to hear. Now, one way LVMH are looking to get around these tariff tensions, these in fact increases right across the board, is they're looking at perhaps moving their manufacturing to the US, but one thing to bear in mind with that, it will ultimately mean that costs of their products will go up. Whether or not there is any price elasticity, whether consumers will continue to buy at the rate they have historically seen, is something to consider. Otherwise, if they do take on the cost themselves, we will see that impact the bottom line margins and therefore become less profitable than they have been on a historical basis. Now, in terms of some bullish news, we have seen the CEO buying a lot of shares, and as we typically say, insider buying, a very bullish signal. They buy when they believe the share price will go up over the longer term, something that Peter Lynch believed in, and we can see he has been doing a lot of buying, the most recent on the 28th of March, where in fact he bought around $30 million worth of shares, and again we can see a very large sum pretty much fairly consistently just over the last few weeks. So one thing we can see here is he does ultimately believe these shares in his own company are undervalued, and he has been continuing to buy. Now, as we said, it is currently in the pre-market, but we have seen on the European Stock Exchange the company shares are down around 8 to 9%, something we will see when the US markets open, and they will end up at a new 52-week low, as in fact we just highlighted pretty much a 5-year low, down 33% over the last year and down 13% just year to date. Now, over the last 10 years, we will take a look and compare it against the S&P, but they have been up 226%, and for the large part, Seeking Alpha do believe this company is a buy. They pay a fairly attractive dividend, which will only increase as the share price does drop, so sitting around the 3% right now, and they're trading at a valuation around the 22 mark. Now let's just dissect some of the issues that this company has faced, and we can already see when we compare their top line revenue against the same quarter last year, it is down around 3%. Whilst they say there's been continued growth in Europe, they see a slowdown in the US, and no surprises but ongoing uncertainties over tariffs, whether or not that will mean an increase, as we said earlier, on the products, or in fact they might have to absorb some of that in-house. Now purely based on a geographical basis, we can see some of the largest customers of LVMH products are the United States, 24% in fact of total revenue, slight increase from the same quarter last year, but the one that is the most is in fact Asia, as we see excluding Japan, 30%, actually a drop from what we saw in the same quarter last year at 33%, but remember this is just the makeup of their total revenue. The actual changes by geographical region is something that gives us a lot more information, and we can see Asia excluding Japan sees a massive 11% drop to their top line, with United States also down as well as Japan. The only real increase to their top line has in fact been from Europe, which is only an increase of 2%, giving us that 3% drop to their top line, something that was unexpected. As we saw earlier, analysts were not anticipating this drop, and if we want to look at it as opposed to a regional basis but on a line by line, we can see the largest hit has in fact been the wines and spirits, down around 8%. Fashion and leather goods also down around 4%. So these have been the two largest drivers for that decrease to their revenue. Again, something to consider whether you believe this is just a short-term hiccup, or in fact maybe this is going to have a prolonged effect and therefore, and ultimately more importantly, affect their share price appreciation over the longer term. Now in terms of whether or not this company is one that is a high quality, we can look at the historical data, look at their underlying metrics. Firstly, free cash flow payout, fairly important given now they are offering a yield around the 3% point. And remember, we do focus on this as opposed to earnings, which is susceptible to manipulation by management through accounting. Below 60% is what we want to give us faith they can continue nice dividend increases. That is what we see, 49% in 2024. And then free cash flow growth, consistent increases over long term. Again, something we do see, large increase from $7 to $27 in 2024, expected to increase over the next 12 months. But again, we do need to also understand and consider the implications of tariffs, how this will ultimately affect the company, whether it does mean they will move their manufacturing to the US, and the cost implications, not just on the products, but also the capital expenditure. In terms of sales growth, very, very inconsistent, although for the large part we do see double-digit increases to their revenue, so a very disappointing 2% drop in 2024 and a 3% drop in just Q1 of FY25, signaling perhaps 2025 may not be a very strong growth year. And if we purely look on a numerical basis, we can see total sales has in fact more than doubled over the last 10 years, whilst very minimal movement to shares outstanding, so this isn't a company that typically returns excess cash to investor pockets through share buybacks. In this case, LVMH do it through dividends, as well as their very attractive dividend increases year on year. ROIC looking good though. We want to see a minimum of 10% to give us faith management are able to effectively allocate their capital, and we can see that well above 10% year on year, 13 in 2024. And then margins, very important, because we don't just want companies that increase their revenue but also show us efficiencies to their margins. 19 in 2015, 23 in 2024, so nice to see, although we can see it is in fact the lowest it has been over the last 4 years. And free cash flow margin consistently above the minimum 5%, now sitting at 16. Finally then, for the metrics, we do want to see the net debt to EBITDA, which correlates to balance sheet strength and dividend safety. Now ideally we want to see below 3. With the numbers here, number of years it would take them to pay off all of their debt net of cash on hand. 1.69, so that is fairly decent over the last 12 months. Expected to go lower, so for now it does look like their balance sheet is fairly secure, something we can touch upon briefly as well. We then move on to the valuation gradings. Unfortunately, given it is a European company, we don't actually have the grade, but what we can see in terms of the PE, the sector median does sit around 17. Given the drop we have seen today, we estimate this to be around the 22 level, but you are still paying a premium for this company by around 37%, something that is pretty much consistent no matter which metric you look at. LVMH is one that trades at a premium to the sector. Question is it one that deserves it? In terms of the growth, now year on year, negative 2%, not great, especially when the sector has been positive too, and their own 5 year sits much higher at 12. Forward looking, estimating for, well, just in the most recent quarter, -3. The sector sits around that level at 3.1, but again, over the last 10 years, they have been growing their revenue at a fast rate, around the 9.8% point. And then we move to profitability, which does look fairly strong at 67% on the bottom line, above the sector comparative at 39, pretty much in line with their own 5-year at 67. Bottom line 15%, well above the sector at 4.4, and not that far off the 5-year average at 15.8. They also do generate a significant amount of cash from operations, 20 billion, a lot higher than what we have seen over the last 5 at 17.7, and significantly above, as we can see, the sector at 274 million. Now, we've already showed you their revenue, which has in fact more than doubled over the last 10, 39 billion in 2015, now sitting at 88, but we want to understand, what does the bottom line tell us? Is it a fairly similar and consistent story? And for the large part, the answer is yes. As we can see, it has increased over the period, going from 4 billion in 2015, in fact more than tripling to 13 billion in 2024, but we need to also consider, as we said, what is the tariff implications going to have to their bottom line and their overall profitability moving forwards. And in terms of the balance sheet, a quick health check, we want to see total cash versus total debt. Cash has increased over the period, 4 billion in 2015, now sitting at just over 14 in the latest quarter. But remember, as always, one number here in pure isolation isn't going to give anything away, so we compare it numerically as well as directionally to their total debt, which we can see has increased and quite substantially over the longer term, going from 9 billion in 2015, now sitting at just under 43. Definitely something we would say to consider, and we saw the net debt to EBITDA does sit around the 1 to 2 points, so for now it does look to be secure. It's also worth comparing their performance against others in the industry. We have Hermes, we have a few others that are very well known, and if we look at total return, so including dividends reinvested, LVMH, one of the worst performing over the last 12 months, down 31, but we can see the industry as a whole hasn't performed that well, only a few that have been positive and very minimal at that point. If we were to expand over the last 5 years, again LVMH up 57%, not the greatest, sitting in the midpoint, but again you do want a bit more from companies over that period. And actually over the last 10, again whilst it is in the midpoint, fairly attractive at 283%, but it will be slightly lower when the markets do open. And the same analysis versus the S&P, we can in fact see LVMH down 31%, the S&P now in fact over the last year up 3.2%. When we expand over the last 5, 45% LVMH, S&P up 90%, so it has outperformed. And when we expand it to over the last 10 years, LVMH has massively outperformed, 283, S&P 158. But bear in mind, past performance is not an indicator of the future. They could perform a lot better. They could in fact perform a lot worse. Now before we jump into the valuation, just to let you know, we have released our latest free weekly article where we cover 2 severely undervalued stocks that insiders have been buying heavily. Now we release one every single Monday morning to your inbox completely for free, where we cover, as we said, undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to gain access to 35 undervalued stocks for the month of April, lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that you can grab a release today copy of stocks that Wall Street believe have the most upside in the S&P right now. So as we said, click below, you can sign up and read these straight away. Now we're jumping into our intrinsic value today, which is updated to $641. We're going to run through each one of these models today just to understand where these are coming from. First one, multiples valuation. Companies in a similar sector and size, their EPS giving us the P multiple. We have the average multiplied by the EPS of LVMH to give us our first intrinsic price, $544, slightly below the market value. So we have our first overvaluation signal. Bear in mind though, we're not looking at any of these models in pure isolation. We then move on to the dividend discount model, where we have some very attractive growth year on year. We've won 6% moving forwards, which does give us an intrinsic value actually above the market price. So we have our first undervaluation. We then have the DCF model with the free cash flow year on year. Average growth 21%. Now we have gone fairly conservative based on the news that we are hearing as well as the tariff tensions. So we've gone 6% moving forwards. With the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as you can see, $689 above the market price with our second undervaluation signal. So $641, purely the average of these three that you see on screen, and as always, you can grab a a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for LVMH or any others. But we're not done there, because we always apply a margin of safety, 10%, execute on that if it meets the 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that in today's episode, a buy at $577, then we keep going till it's near the current trading price. And what we're saying is, at today's price, you're getting a near 15% MOS, $545, with Wall Street themselves $680 over the next year, translating to 23% upside. So give us your thoughts. Is this one worth considering? Near 15% MOS, 23% upside. For those that want to see a little bit more, well, at 20%, a buy at 513, at 25, around 480, and for those that want 30%, 448. As we said though, near 15% MOS, 23% upside, LVMH in your own eyes, buy, hold or sell. Don't forget, as always, sign up to the free weekly newsletter, grab those spreadsheets, come and join us in Patreon as well, where we cover our weekly buys and sells. And as always, have a great day. We'll see you all on the next one.